Welcome friends once again to the module of NPTEL MOOC program entitled as International Trade Theories and Empirics. We are on the 42nd lecture on trying to understand the trends of balance of payment after the previous lecture on concepts and definition of balance of payment. Now, understanding the previous lecture once again, balance of payment composed of majorly two sides, one is called debit side and credit side, and from the different heads like current account and capital account. Accordingly, we define whether the balance of payment is in surplus or is in deficit. Now, last class specially I mentioned about one newspaper site which has been recently highlighted the growth of India's balance of payment scenario and postulated for a positive current account balance. Especially the author highlighted about growth of its exports as compared to imports due to the COVID-19 setbacks. The country's imports has been hardly hit, and that has also been corroborated by fall in the aggregate demand, and that too. So in totality, the aggregate balance of payment, that means export and import balance of in the current account side, the balance of payment is in surplus. So, this is what we discussed as per the Hindu Business Line published in May 21st, 2020, and we discussed that India has reported a current account surplus of 19.6 US billion dollar, and that is of 0.7% rise in the GDP in the year financial year 2021. So, even the ministry has confirmed and expected for even higher rise. So, coming to one by one once again regarding other updates, we already started in the last lecture, but could not able to emphasize. And this now will be emphasizing on the updates of the BoP, especially highlighting the fact that the current account deficit narrowed down to 0.9% of its GDP in 1920 from even higher, that is 2.1% in 2018-19, on the back of trade deficit which shrank to the amount that is 157 billion US dollar in 2019 from 118 US billion dollar in 2018-19. Now, coming to the net invisible receipt, were also higher in 2019-20, mainly due to the rise in the net services earnings and private transfer receipt. So, the services has actually contributed better in terms of the BoP surplus in the accounting record. Similarly, the net FDI imports reported at 43 billion US dollar in 2019-20, which were higher than the 30.7 US billion US dollar in 2018-19 to 32.43. So, in all those heads, so the aggregate balance of payment is expected to be better. Now, also in the portfolio front, the inflow was of 1.4 US billion dollar in the 2019-20 as against the outflow of 2.4 US billion dollar a year ago. Okay. So, increase basically is against 2.4 to this. Now, in 2019-20 there was an accretion of 59.5 billion US dollar to foreign exchange reserves. That is also another important aspect on a BoP basis. Foreign exchange reserves in nominal terms, including the valuation effects, increased by 60.9 US dollar billion US dollar during 2019, as against the decline of 11.7 billion US dollar in the preceding year. So, regarding foreign exchange also we discussed in the beginning of our lecture as well. You can check that site. Now, it has covered so many things, but we need not worry about the down invisible rows. These are not so important, only we are concerned with the different heads in different time. Now, current account, it covers current account, it also covers if you just simply click here, it will be enlarged, and in red current account it covers capital account. Within current account, what are the different heads it covers? So, what are the credit side, what are the debit side, what is the net side? In 3 directions we get the value, and these can be these can be taken from RBI website. Okay. And within current account, that is entered as head A and also B. Within B is as capital account, also includes financial transactions. Now, within current account it includes merchandise and invisibles. Invisibles largely services, and there are some invisibles also. Within invisibles we include services, then transfers, then also income channels, then investment income or compensation of employees, etc., are called invisible incomes. So, within services, but first of all current account includes merchandise trades and services. So, merchandise trades are basically the physical import and export items. Invisibles are the services, largely services. Services includes travel, then transportation, insurance, then GNI, basically it includes different indicators of the services, then some miscellaneous entries. Okay. Now, coming to there are, you can check all those details from the RBI website for better clarity. Now, regarding the understanding of the current account balance, we must focus our explanation to comparing other years. Like here is the chart from 1975 till 2019. 2019 it is here. All right. So, this is the source from World Bank. Okay, 75 till 2019. It indicates that the current account balance and its magnitude is at a high level. Now, 0 indicates your about balance. Okay, here is 0. The line more or less hovering around the 0, but especially from 2005 onwards, or you may say 2000 yes 5-6 onwards, and till to 2011 or 12, there has been a major problems in the balance of payment. Actually, the major fall is identified especially in the aftermath of bubble crisis that has come to the world economy, and especially in Western economy or US economy, due to the subprime crisis. So, the effect is also was also there to Indian economy due to its connection of financial transactions. Lehman Brothers, as you might have heard, was hardly hit, and even in Indian context, first company that was crashed in 2009, especially 9-10, that was Satyam. Okay. So, after that there was a major fall in the current account balance, and after that there was a steady rise, and again from 2015-16 onwards we have been experiencing a major problem in the balance of payment, especially in this head. Now, this World Bank also gives information about net capital out account. The current account we have already checked, capital account in US dollar in PPP terms were also given now till to 2019. Now, in capital terms you can see there are surpluses also in different years, but now I think in the recent years recent years there has been major negative aspects attached with the capital account. Okay, that is again very problematic to Indian context. Let us now examine the detailed trends of India's balance of payment. Okay, India's balance of payment is broadly divided into different years. If you simply check the history of India's balance of payment. Now, we divided the years into period 1, period 2, period 3, period 4, okay, and period 5. Out of that, first period we simply want to explain that it is also referred to as the time from 1975 to 76. So, that is the period called period of deceleration. Okay. That was due to very high imports, and that has caused the current account deficit to reach at 1.8%, and also very low foreign exchange reserves within RBI. Okay. And since it is called period of deceleration, I think you might have heard about the problems of India's post war period, post within our neighboring countries there are problems during that time, and also due to the political problem within the country has raised a concern for the deceleration. Now, in this another period, that is called period number 2, is also called a phase of transition. Okay, and that has been counted till 1979 till 80. Okay, till is written because the previous period is also counted as transition. Okay, so this is basically also called a golden years of BoP, because of the case that the BoP has experienced a surplus. This is also period 2 is also called a favorable year, and there were export of invisibles, and that has been resulted due to positive in the balance of payment due to the invisibles exports. Okay. The third phase is counted as called the further imbalances. Instead of balance, imbalances, especially 1989-90 period, where there was major balance of payment problem within the country. So, 91 onwards India has taken a major stand to open up the economy to the world. The end of 80s, India experienced again problem of huge current account deficit of 1.3%. Okay, and especially this was experienced, this is the period referred to as 6th plan period and 6th and 7th plan period. The current account deficit was of 1.3% and 2.2% respectively in these two plan period. So, that is the reason why it is called a further a stage of further imbalances. Now, the fourth period is counted as the period of stabilization from the earlier periods till 1995-96. Especially in the 1991 is considered to be a disturbance phase because of the fact that India opened up its economy and liberalized in many direction, and then the current it's called current account phase of stabilization. even though this current account deficit was even higher 3.3%, but the preference was given to non-debt creating capital. So, India started replacing the highly debt assets to non-debt creating capital. Those have been flown from to the country, and in 1995, especially in the 1994-95 budget, it was discussed. And another important step was taken, the India's current account convertibility by the Tarapur committee was finalized and implemented. So, basically Indian currency is fully convertible or has been fully convertible from 94-95 budget year, and especially in all kind of current account transactions, Indian rupee was made convertible in the international transactions. So, now the last phase we deal usually count as the period till 2007, that is called resilience and surplus. Resilience and surplus, and due to we experience surplus in a balance of payment. Then after 2007, though we have another setback in 2009 till 2014-15, but then 15 onwards another reverse trend is expected, but somehow due to COVID-19 the things are now in a different shape. We also try to check the current account deficit position in 2013 data, and the current account deficit in 2013 to understand the recent changes without change of the earlier history. The current account deficit was of 4.2% of GDP in that year. The average balance of trade deficit was running at minus of 15.91 billion US dollar per month. The share of manufacturing goods and engineering goods in export was only 41%. This needs to expand to at least 15 to 20% every year. Then as suggested by the committee, petroleum export similarly was of 169.4 billion US dollar, etc. You can follow it from the PPT. Checking the India's balance of payment position in 2013 to have a comparison with the earlier years, we mentioned that the net financial flow financial accounting balance was positive, but the net was in deficit. Okay. So far as financial account is concerned. So, it has been mentioned that India's bonds to be issued to international currency, I think that has already been issued to international community. Now, BoP position as of the end of March 2013, it was 105.552 billion US dollar in its capital account. Now, coming to the important points to be noted here is that India's CAD problem has been shaped by the factors of remittances by Indians working abroad and invisible, especially for softwares and BPOs, but these factors are reliable and only under favorable circumstances. Similarly, there are other aspects like the tourism and transit facilities needs major boost for countries balance of payment scenario. And as I already mentioned in the last class that this is the data we take it from today itself. I took it from Reserve Bank of India site, a website I have already suggested in the previous lecture. In the site we can check the July to September 2019 provisional estimate. Even the first quarter of 2020-21 has already been published. So, in the current account it is negative, and in the whereas you can just have a, in the B category in the capital account it is positive. So, but in these two heads we have relatively higher capital account entries, So, there are also errors and omissions that makes it to the net changes in the balance of payment. All right. Now, coming to the discussion for another 2-3 minutes is on the last slide to be discussed is on causes of deficits and measures. We have already started discussion in the last class, but I mentioned to explain it in this lecture. So, when we have different phases of deficits, India has been consistently taking import substitution approaches, the facilitating the industries which could substitute the imports. Also taken India has been very active in imposing restrictions which are of non-tariff types. So, the TBTs, technical barriers to trade, and SPS measures, sanitary and phytosanitary measures are occupying higher percentage space out of the total restriction India raised in the world. Okay, so India has been defined as a very restrictive country, and that is helping the balance of payment front. Then next important aspects for deficits and its measures is extending assistance for export promotion, providing incentive for foreign exchange earning on account of invisibles. Then especially from 1991, India has put comprehensive strategy to improve its balance of payment scenario. Like fiscal and monetary disciplines have been in place. Control aggregate demand in this direction was important, and India has been promoting. Then coming to the exchange rate and foreign trade policy reforms, we have already discussed some of the few steps. Then structural reforms like deregulation and delicensing of the industries which promote imports. Then also it promotes competition through FDIs, FIIs were facilitated. Then financial sector reforms was required, and mobilization of exceptional financing is also necessary to measure our balance of payment. Many of the steps have been taken, and since this lecture is not targeted for each of the heads to be explained, so I am not putting a detailed discussion here. So, whenever it is required, we will go for it and explain. So, these are all aspects of balance of payment and its measure so far as trends of BoP is concerned. So, I will look forward to your participation in the next class on exchange rates. Okay. Thank you so much.